China just gained the upper hand in a war America thought it was winning. Bessent demanded Beijing surrender its currency weapons, yet it was the dollar that collapsed. Now U.S. factories are choking on their own tariffs. Ocean freight from China, down 60%. Retail shelves could run dry in 5 weeks. As Washington scrambles, Trump's ordering Britain to cut ties with China, only to be met with silence. Meanwhile, Beijing's playing the long game. This isn't policy, it's economic warfare. So what happens when your biggest ally stops following your playbook and your biggest rival starts writing the next one? Scott Bessent's call for China to maintain a strong yuan while the U.S. dollar weakens wasn't just bold. It may have been structurally self-defeating. The U.S. dollar index has plunged nearly 10% since January 2025. But instead of fueling a manufacturing boom, it's inflaming cost pressures across U.S. supply chains still reliant on Chinese components. The tariffs Washington imposed, some reaching as high as 145%, were designed to force China to pivot inward. But with intermediate goods blocked and domestic industry underbuilt, the dollar's fall is feeding inflation rather than exports. You can't devalue into a supply shortage, said Mark Zandi, chief economist at Moody's, in a recent note, warning that the combination of tight inventories and import costs was a perfect storm. Meanwhile, the yuan has remained remarkably stable, devaluing just 3.2% year-to-date, showing that Beijing isn't folding, it's watching. And with $17.2 billion in net short positions placed against the dollar last month, according to CFTC data, global markets are betting Bessent's gamble is already spiraling out of control. The U.S. dollar index dropped nearly 10% between January and April 2025. Falling from 105.2 to 94.8, according to Bloomberg. A plunge that was supposed to spur exports, but instead triggered higher input costs for U.S. manufacturers still dependent on Chinese goods. Meanwhile, China's yuan has held relatively firm, slipping just 3.2% over the same period, a stark contrast to the 14.5% devaluation during the 2018 trade war. As Scott Bessent called for a stronger RMB and a weaker dollar to rebalance global manufacturing, Chinese policymakers quietly took advantage. The People's Bank of China cut its one-year loan prime rate to 3.35% in March, fueling domestic demand without currency instability. The dollar decline is now working in Beijing's favor, says HSBC strategist David Bloom, who warned that a soft dollar with no industrial substitute in place creates stagflationary conditions instead of export growth. The contradiction Bessent failed to resolve is now being exploited by China with precision and patience. U.S. retailers are now caught in a countdown they can't escape. As of April 2025, shipping volumes from China to U.S. ports, especially Los Angeles and Long Beach, have dropped by 61%, according to data from Flexport and Panjiva. The National Retail Federation warned in a joint statement that inventory levels across major chains like Walmart and Target will begin to show critical strain within 5 to 7 weeks unless imports normalize. The culprit? Tariffs that now range from 75% to 145% on core goods like electronics, auto parts, and textiles. That's pushed costs up across the board. The average landed cost of consumer electronics rose 32% year over year, according to UBS, while the price of imported furniture has surged 45%. Meanwhile, the CPI for core goods rose 1.1% in March, its sharpest monthly spike since 2021, signaling inflationary pressure from broken supply routes. And yet Washington insists the tariffs are temporary leverage. If that's true, the clock is ticking, loudly. When Bessent called for a rebalanced global economy led by U.S. manufacturing, he overlooked one foundational truth. America's industrial ecosystem is still under construction. According to the Federal Reserve's March 2025 Industrial Production Report, U.S. factory output contracted 0.6% month over month, while capacity utilization slid to 76.8%. Both signs that reshoring efforts remain years behind. Simultaneously, core producer prices rose 1.3% in Q1, driven largely by elevated costs in construction materials and imported machinery, both of which rely heavily on Chinese suppliers. And the labor market isn't filling the gap. The Bureau of Labor Statistics reported a 17% year-over-year drop in U.S. manufacturing job openings in February. Without stable inputs, skilled labor, or scaled domestic output, the weaker dollar becomes a cost multiplier, not a growth catalyst. As economist Mohammed El-Arian noted in a Bloomberg panel, this isn't dollar diplomacy, it's dollar dysfunction, and the markets are responding accordingly. Beijing's central bank has shifted into a tactical stance, using the falling dollar as cover to launch targeted stimulus while preserving export competitiveness. The yuan has traded within a controlled band of 7.19 to 7.25 against the dollar since February. Even as the U.S. dollar index slumped, that stability gave the People's Bank of China room to inject over 1.5 trillion yuan, or $210 billion, into state-owned banks via low-interest lending facilities, according to Caixin. Meanwhile, exports remain strong. China's March trade surplus hit $103 billion, led by a 17% increase in shipments to ASEAN countries and Latin America, per customs data. They're effectively buying time to rotate growth inward without triggering capital flight, said Alicia Garcia Herrero, chief economist for Asia Pacific at Natixis. Beijing's playbook isn't reactionary, it's surgical. And by keeping the yuan stable while the dollar drops, China is managing to defend both its factories and its monetary flexibility. The UK now finds itself at the intersection of geopolitical loyalty and economic reality as U.S. pressure to sever trade with China escalates. Peter Navarro's April 2025 comments in The Telegraph, labeling Britain a compliant servant of communist China, accompanied a behind-the-scenes push from Washington for London to halt Chinese imports redirected from the U.S. market. But the numbers don't support immediate decoupling. In 2023, China supplied 7.3% of UK imports and just 4.1% of its exports, according to the ONS. Cutting those ties would directly hit key sectors, especially electric vehicles, where British EV manufacturers rely on Chinese batteries and components that have no immediate European substitutes. Chancellor Rachel Reeves responded bluntly, stating, "It would be very foolish not to engage with the world's second-largest economy." Meanwhile, the London Stock Exchange is evaluating Shine's IPO, despite bipartisan scrutiny in Parliament, indicating that pragmatism still has a foothold. So the question is no longer whether the UK wants to comply. It's whether it can, without detonating its own industrial future. Despite sharp rhetoric from U.S. officials like Peter Navarro, who in The Telegraph accused Britain of being a compliant servant of communist China, London is resisting American demands to sever ties with Beijing. Chancellor Rachel Reeves publicly warned that disengaging from the world's second-largest economy would be foolish, especially as the UK faces stagnant productivity and widening trade deficits. According to the Office for National Statistics, China accounted for £62.6 billion in UK trade in 2023, nearly 7% of total goods movement, critical for sectors like electric vehicles and pharmaceuticals. The UK is also pursuing Chinese investment, including a potential Shein IPO in London, signaling divergence from U.S. decoupling strategy. A leaked cabinet briefing reported by The Guardian showed internal resistance to Washington's tariff-based coercion, with one senior advisor calling U.S. demands economically self-destructive. While Washington escalates, Britain is calculating, quietly pivoting toward resilience, not alignment. Peter Navarro's April speech claimed, "If the Chinese vampire can't suck the American blood, it's going to suck the UK dry," but that narrative is unraveling under scrutiny. China's outbound foreign direct investment into the UK dropped 27% year-over-year in 2024, according to Rhodium Group, not expanded. British regulators have also blocked Chinese involvement in nuclear and telecom infrastructure, including Huawei's exclusion from 5G, a move led by MI5 Security Advisory. Navarro's framing ignores these facts, instead pushing ideological alignment at the cost of strategic nuance. The UK has taken calculated steps, not capitulation, says Fiona Hill, former U.S. National Security Council advisor. The danger lies in mistaking inflammatory analogies for policy. London sees trade as a negotiation table, not a battlefield, and it's betting that moderation, not maximum pressure, is the currency that holds value. With both economies under pressure, the trade war is no longer about leverage, it's about optics. Trump, facing a Q1 2025 GDP contraction of 0.3% and a 1.1% decline in real wages, is scrambling to frame tariffs as victory, despite soaring import costs. Xi, meanwhile, is juggling 5.3% youth unemployment and a property sector that saw a 22% year-over-year drop in housing starts, according to China's National Bureau of Statistics. This is now a two-level game, says Dr. Wen-Tai Sung of the Australian Centre on China in the World. Both leaders are managing foreign brinkmanship while signaling control at home. Trump's narrative centers on reclaiming industrial might. Xi's narrative focuses on resilience and multipolar strength. Neither leader can afford to blink first, because behind every customs declaration is a political campaign ad. And, as domestic pressure builds, so does the risk of policy distortion overtaking economic logic. Publicly, both Washington and Beijing claim they're ready to talk. Privately, neither wants to be the first to move. The Chinese Ministry of Commerce said it's assessing negotiations, while U.S. Treasury officials insist the door is open. But that ambiguity is strategic. A Weibo account tied to China Central Television stated bluntly, the U.S. must be the more anxious party. Meanwhile, Treasury Secretary Scott Bessent told IIF delegates there's a real opportunity for a big deal, if China's serious. This vague posturing reflects a diplomatic tactic known as constructive ambiguity, used historically in U.S.-Soviet arms talks, and now repurposed for economic warfare. It's about preserving face while probing for compromise, says Jia Ian Chong of the National University of Singapore. The world sees two superpowers stalled. But underneath the silence, positioning continues, and the first to speak risks losing the narrative war. As of late April 2025, CFTC data shows $17.2 billion in active net short positions against the U.S. dollar, up from $9.8 billion in January, driven by weakening fundamentals, not speculation. Bloomberg's dollar index has slipped nearly 10% year-to-date, dragged by trade imbalances, policy uncertainty, and collapsing import flows. Meanwhile, the yield spread between 10-year U.S. Treasuries and Chinese government bonds has narrowed to just 32 basis points, its tightest margin since 2006, reducing the incentive for global capital to favor U.S. assets. This isn't just about trade anymore, said Morgan Stanley's Ruchir Sharma. The dollar is becoming the casualty of U.S. industrial unpreparedness. China, in contrast, is managing a gradual Yuan float while executing a 1.5 trillion Yuan stimulus without triggering capital flight. The very financial system that once protected U.S. dominance is now enabling a reversal. If the dollar keeps slipping, Beijing may not need to retaliate at all. It can just wait. The trade war is no longer bilateral. It's cascading into multilateral realignment. According to WTO data, China's exports to the BRICS bloc rose 19.4% year-over-year in Q1 2025, while exports to the U.S. fell 31.7%. Simultaneously, the EU's internal trade increased by 12%, driven by strategic stockpiling and alternative sourcing. In the middle, the UK is negotiating parallel deals, one with Trump's White House, which insists on lower non-tariff barriers for U.S. agriculture, and one with Brussels, aiming to preserve frictionless EU trade. This is the stress test for globalization 2.0, said Adam Tooze, Columbia historian and author of Shutdown. If countries are forced to choose between dollar-centric security and yuan-enabled affordability, alliances could fracture. What emerges may not be a new bloc, but a tangled web of economic loyalty shaped less by ideology than inflation rates, labor costs, and shipping lanes. The world isn't decoupling, it's repricing. So, let me ask you, who's really shaping the future of trade, governments, or investors? Is this just a phase in a larger standoff, or are we watching the birth of a new world order without a single center of gravity? Drop your thoughts in the comments. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.